Good evening and thank you very much for joining us tonight for our webcast investor briefing regarding the Dispersion investment opportunity. This is an investment, I guess, that is probably timely, but in many ways the short-term timing of the market is very much irrelevant, but timely in terms of a reminder of the volatility that we can experience from time to time. But I guess a lot of the time when we see the moves that we've had in the last couple of days, it takes us back to periods like 2008, 9 and so forth, where there has been a lot of volatility in the market compared to the incredibly low levels of volatility we've experienced recently. Even with the moves that we've seen, volatility at 14%, implied volatility today in the market is nothing relative to that was lower than a normal day in the market, significantly lower. 3 years ago it was probably sitting at 18 to 19% and levels up to 30% on a short-term big correction like it we've just seen, or little correction I should really say. But this is an investment designed ultimately to benefit from market volatility and global political events or economic events and the like. So given that the way that most of our portfolios are set up, if your portfolio is anything like mine, littered with lots of things that like the market to go up, not necessarily require the market to go up and be strong, some of them do, but very few things in the portfolio that actually benefit from the market collapsing or a big geopolitical event or black swan event coming up. So interesting investment. For some people, they'll see this as a potential hedge, and others will take a directional view. We've had both, and it has been very, very popular. We've recently had a similar investment to this, and even though volatility stayed low for this investment, is done incredibly well in a very short period of time. So Reach Markets, who are we? Well, we do a range of different things. We work with private equity and VC firms as part of the process there to work with their investors and our own investors to bring investment opportunities that you would otherwise not get access to. And we also have a range of different investments that we'll look at. We look for international investments, and we'll look for an investment like the Dispersion one that meets a theme or meets a need for a portfolio for the type of investors that we have. This investment, like many of our investments, is for wholesale investors only. And if you've got any questions about what it means to be a wholesale investor and the like, certainly speak to one of my advisors, and they can give you all the details you need there. But we're also the education partners of the ASX. We've got leading technology in the derivatives market and run one of the busier options trading desks in Australia. So again, just to sort of cap, I think this is an investment that's rewarded from market uncertainty, benefits from an increase in volatility, which in many ways you're going long volatility, and given volatility tends to revert to the mean, we're at historical lows. That's been one of the things that's been very attractive to a lot of investors, and it's designed to act as a hedge for a major crisis as well. Any advice contained in the presentation tonight is general only. It doesn't take into consideration your personal circumstances, and you need to decide for yourself whether it's appropriate for you. Past returns are not an accurate indicator of future returns. If you've got a question throughout the presentation this evening, you've got a chat box. Pop it into that chat box. If your chat box isn't open, a red arrow top right hand corner of the screen, just put it in there, and I will make the attempt. I'll try and answer it as it comes up, but otherwise I'll take detailed questions at the end. Now this is a topic that I really enjoy talking about as a trader. Implied volatility, or volatility, is something that I trade and have done for a couple of decades now, and as an investor it's something that I consider and look at as well. When we talk about volatility, I have the distribution rights to a platform called Implied Volatility. I own the URL volatility.com.au. We've built some volatility tools. If you visit volatility.com.au, you can actually put a volatility analysis of any stock in the market, which was just something that we put together. So we like volatility. Why be long volatility? Well, you know what? We've been in a very long bull market. The guy with his hands, head in his hands here. I mean, we've seen a little bit of this, but not a lot of it. the market could definitely keep going for some period of time. But there are plenty of things to be worried about. These two guys, for example, I mean, I make an observation each week in my newsletter, and really probably just to observe the rhetoric. I don't believe anything anyone says on either side. I don't take comfort in any sort of any jawboning that goes on around the trade war and it's de-escalating or it's whatever. It means nothing to me. I mean, at the end of the day, there's stuff going on, and it could escalate, it could de-escalate, nothing major could come out of it, or the ramifications could be significant. Worldwide, global issue, right? And if it escalates, I don't think we really have thought through the problems that can occur, or when we've certainly people have thought through it, but play that forward and the impact that that can have to different companies and to the overall market. That would be something that would trigger a lot of volatility and also increase dispersion massively if that escalates. The bull market that we've been in is really interesting. I mean, the last bull market went for 10 years and finished in 07, 08. So we remember what happened with volatility after that, right? And dispersion as well. So this current bull market's been going for 11 years. It could keep going. I'm not here to predict that it's going to stop or it's stopped or put a time frame on anything. At the moment, technically, it's still looking bullish. But is it going to go for 11, 12? You know, at what point will the correction occur? You would be mad to think that history won't repeat itself at some point in time. There will have to be some bloodletting. All right. So this investment is designed to position yourself for if any of those types of things eventuate, you've got an investment that can greatly benefit from it. So it's if you want a hedge, right, and an international one, if you want an investment that's got cap downside, so it's a leverage product, and I'll go through that. So what the benefit of that in this instance is it allows me to get a hedge in place. I'm not short selling. I'm not risking relative to what I can. I don't have to risk a huge amount relative to the exposure level that I can get, and this investment's put together on that. And again, it's for someone who wants an investment that benefits from uncertainty and also catastrophic events. It doesn't need catastrophic events to benefit. As I mentioned, the last investment we put together on this, which closed a couple of months ago, has had incredible returns in the time it's been running, and volatility's probably lower than where it was. Well, maybe not today, but the average volatility over that period of time, which is what the investment looks at, it's definitely hasn't gone up. But what happens is dispersion has, right? So a catastrophic event will have a significant impact. At this stage, all we've seen on that basket that we put together, or that was put together, was an increase. These types of investments, this particular investment was put together for hedge funds and for them to be able to articulate or put hedges into their book, or actually just take directional views as well. All right. So to understand how the numbers behind this will give you some clarity of how it works. So if you wanted to take a $200,000 worth of exposure, the net outlay is $14,800. Right? So it's a 2-year investment term. You've got your maximum risk is the $14,800, but you've got uncapped upside based on the $200,000 exposure level. All right? So it allows you to get that exposure in place, potentially hedge, and you can take however much you want. You can go less than $14,000, and you can take $100,000 uncapped upside if you want. Speak to the advisors, Dave or Blake or Michael, and they can go through the different numbers depending on what you're actually looking for. All right, so again, this investment, how is it put together, and how what are we looking at, and I guess for some people also, what is dispersion? So dispersion is something that we talk about a bit in our line of work, and volatility is obviously something we look a lot at as well. What is dispersion? Really simple way of looking at it is if you look at the blue line here, this is tracking a stock, right? And the red line is the index. The difference between The index and the stock is the measure of the dispersion between the stock and the index, right? So I could put, and I'll show you a graph a little bit later, where there are lots of different stocks plotted around an index, and that can give us an overall understanding of the dispersion of that basket of shares or group of shares, or it could be the index itself versus the index performance, the overall index performance, right? So the reference basket, again, it was put together and designed for hedge funds managers, and they've chosen the stocks that make up that basket accordingly. Now, so again, the things that will benefit this is the underlying volatility of the different companies increasing, right, is what we're looking for, and the dispersion in performance of the overall performance of these companies versus the individual performance of these companies. And I'll show you a chart in a moment that will articulate that possibly a little bit better for you. So they've got different driving forces that will have significant impact on these stocks, which is designed so that as certain things happen, they end up taking off in different directions. And there is an expectation that they would naturally disperse from where they currently sit today, right? So from major events will impact them, geopolitical, economic, market-based, and inflation, currency movements, specific geopolitical events, and so forth, are all in this and built, and it's constructed on the basis that it will work for dispersion. So when we look at high levels of dispersion versus low levels of dispersion, at the moment we've got a high correlation in the market. The stocks are highly correlated. So we'd say that's saying there's low dispersion of returns. So you can see the chart on the left-hand side. You're looking at the performance as a percentage base on this axis here, and then you've got time, right? So what we can see here is that, you know, the market's moved, but the stocks are sort of clumped around it. Now, in times of low dispersion, it's really hard for funds managers who are stock picking to outperform the market. And, you know, we've seen that over recent times. Is the difference, you know, how do I add value as a funds manager? Very difficult to do, because basically most companies are doing similar sorts of stuff. But when we see market conditions change, there might be a flight to value, away from growth, or whatever it might be, you'll see that the index and the stocks will disperse, right? And you can see that, you know, over on the left-hand side, there might be one stock's gone up 2%, one's gone down 2%, one's in the middle. Overall performance is pretty flat. Over here, the same performance is flat, but one stock's gone down 10%, one stock's gone up 10%, right? So that there's a dispersed movement. So what we're saying is that this investment will greatly benefit from moving from its low correlation, low volatility to a higher dispersion and higher volatility, right? And that can just happen because things revert to the mean, and they tend to, you know, and volatility sort of tends to revert to a mean. But with dispersion, they will greatly benefit from major geopolitical event, economic event, market-based events. You'll see this spread, and performance may suffer as well. So, you know, it benefits from, you know, it's possible the market could go up for a year and then come back and give up all its gains. Volatility's through the roof, dispersion's through the roof. Your portfolio hasn't really, you know, it's impacted for over a 12-month period, but overall where you're standing, start from where you enter into an investment like this, it hasn't gone anywhere, but your dispersion has done incredibly well. So it doesn't actually need for things really to go too badly, even if it just reverts back to normal levels. This can do incredibly well. So we can see here, as far as is this an ideal entry point, it's one of the reasons why it's been something that I've been very, very interested in, and we've been looking for these types of investments. You can see here volatility, you know, is at a really low levels, and it has bottomed out, and it has not got any better. And at the same time, correlation is really high, right? So high correlation means low dispersion, simply put. So do we expect that correlation will go back to a more normal level? Then it does not require a massive event to occur. Do we expect volatility to go back to revert back to a mean or a normal level? Yeah, there's definitely a case for that, and it's one of the reasons why we think entry point for now is a really interesting time to be able to get in, right? Now, if you equally think that there is a major issue that's coming up and you wanted to trade that view, this is a way of trading that view. If you think that you would like to have something in your portfolio so that when you go to sleep at night, you're not worried about a calamity. You're not thinking back to how you were feeling about the market, your portfolio, what was going on back in 2008, 2009. If you want something that could be greatly benefiting for that, either there as a hedge, then this investment is one that is a really interesting one to have as part of a portfolio, right? So it could be a directional view, and certainly there have been quite a lot of people that have been attracted to this type of investment that are actually just looking for ways of being able to benefit from volatility, dispersion, market corrections and the like. This does that job, and equally there have been an equal share of people that are saying, you know what, everything in my portfolio is long. I know that when I look at the next thing that someone puts in front of me, it'll benefit from the market going up or at least maintaining its current levels. It won't want volatility necessarily. This is an exception to that. All right. So how does it work? Well, what we're looking at here is a case study, and so I'm going to take you to the column. You can see my mouse over it. It says total investment outlay, right? So if you decided to put $34,500 into the portfolio, into this investment, I should say, then you would get $500,000 worth of exposure to this particular investment. All right. So if the dispersion less the hurdle at maturity was 6.9, then at the end of the period, you're not going to make money, you're not going to lose money. All right. If dispersion does nothing, volatility does nothing, it's still at the record lows, that probably means the market has been going great guns, by the way, and you'll have lost your initial investment. Okay, so that's the risk, and that's the worst case scenario for you, is if it doesn't do anything or it was to go down, right? Which means that most likely in the event that that was to occur, you would probably see a very strong market. So again, if you're like me, you're probably pretty happy and the rest of your portfolio is doing exceptionally well. All right. If the market and the dispersion levels were to increase, and I know that the investment we went into a few months ago is now sitting at a 13.8% rate, and that is it needs to maintain that till expiry to get the maximum return out of that level. But then you've increased your return on your initial outlay by 100%. Right? If it was to go to 20.7 or 27.6. You can see that's 200% or 300%, or from a $34,000 initial outlay, $103,000. And those levels are good levels for it to get to. But if there was a big market shock and we saw volatility rates, IV rates up to where they're sitting at the moment today, we're looking at 14. They'll be sitting around 10, and then if they can easily be up at 40%, then these numbers are not big numbers. All right, so. The interesting thing in this is the significant amount of leverage that you get in, because interest rates are really low, and as are the dispersion and volatility levels as well. All right, the sort of cash flow and setup, it's worked off a loan rate on the $500,000, 2.95%, which is very low interest rate. That comes up with the interest for the 2-year term of the investment. There's an advisor fee on that level, and so your total investment is $34,500. Right? Now, but you don't have to go that large. You could do $7,900. Would give you $100,000 exposure, $14,800, $200,000, and so on and so forth. It's really up to you what level you wish to take. It'll be individual, and it's your decision. All right, now. Going back to it, so the net outlay of $14,800 to give you $200,000 exposure to your investment term. Maximum you're risking is $14,800. Really important. No margin calls. You pay the total investment up front. That is your maximum risk. and you've got uncapped upside, right? So capped on the downside, highly leveraged as you can see, but as a hedge, we like that about it, and it's possible because of that incredibly low interest rate we're able to get exposure to. So, you know, in this current market, in these conditions, it benefits from, you know, problematic markets. And if you're predicting that, and that's your view, this can do that job for you really, really well. And on the flip side, if you're someone that thinks it might happen, you can still see the market going ahead, but you want to put hedges in. It's something that you can slide in there, and it's not a massive outlay. Well, you can do smaller amounts as well, but it sets you up with a pretty good hedge in there, depending on what level you want to go to. All right. So why people are considering this now? Well, you can position it to benefit from market uncertainty, cut your portfolio at the least, and if you think there's a correction or a good chance of a correction in the next 24 months, it's there as well. But it also is there if there's a black swan event, a major geopolitical event, the economy, a trade war, those types of things, they're very good. But even if it just reverts back to the mean, in another market where volatility is sort of at normal rates, and so is dispersion, and interest rates are at normal rates, to set up a hedge like this is going to be more expensive, and you'll need something big to happen for that hedge to pay off for you, right? Whereas in this current market conditions, we can get set at completely different levels. Now, we still need the move, you know, you need it to revert to the mean, or you need a big event to occur to get the maximum out of it. But at the current levels, even if there's a reversion to the mean, it allows you to benefit, all right? And coming back to these two slides here, this chart here we're looking at is volatility on the left-hand side at these very, very low levels, and the correlation at very, very high levels. High correlation, low volatility. They generally are the opposite of each other, all right? So volatility increases, you know, off it goes. Maximum risk is the amount that I put in. That's correct. Comment about it being a managed fund. It's not a managed, well, it's a structured product. So the investment is set up. Yeah. Yeah, no problem. If you need us to go through anything, just let us know and I'll get someone to talk you through it. If you would like the prospectus sent through, or it's an investment memorandum, type in yes into the chat box and we'll email that across for you. If you, okay, John's asked, have we done something like this before? Yeah, John, we have. We got into an investment a few months ago, and that even in a period of time where dispersion has not increased, overall dispersion of the market hasn't increased. This is, I think at the end of November, it was at 1504 was the level. And if you took that all the way through to maturity, that would be sort of a tripling of your initial investment. And so that's happened. Why has that happened? Because the basket, the investment basket that was put together, the stocks within it have just dispersed, right? So volatility hasn't had a role in that yet. Get volatility in there on a major market event. Well, that's what it's really, that's why people are really in it, for that type of event. But that hasn't happened yet, clearly. I mean, the last couple of days we've seen a bit of movement, but I mean, I'm not yet paying too much attention to that type of move just yet. We'll see. We'll see. It needs to do a bit more before I change my view. What would the fund manager invest in? Global? Okay, so let me go back to the basket of shares. Maybe that's going to answer the question. So this is put together. Hedge fund managers invest in this investment. Okay, so it's not a managed fund as such. It's what a hedge fund manager is looking for to articulate a view. So if you're a funds manager and you're going, look, I really want to get myself set up with some hedges or some things that benefit from, we think, that the theory, the hypothesis of the investment team, and I've sat in plenty of these meetings, is someone says, we believe that volatility is low. How do we make money out of that? or we need a hedge in our portfolio because we're really worried about these things that are on the horizon, and we need to have something in there. And the different funds managers will have different terminology they'll be using to articulate what they're trying to achieve. But in this case here, this is the basket of stocks. So and they are, the driving forces behind them are different. So if you look at that basket of stocks and you want to understand how the investment works, well, if those basket of stocks, the overall, we're going to track their performance. Let's say that this tracks their performance, right? And at the moment, there's a high level of correlation between them. Then if we plotted that performance over time, then it would look something like this. What we want to happen is there's a reversion to more normal circumstances and they start spreading out a little bit more, or there is a significant event, which means that, or a range of different events that puts pressure on the different stocks that are in the basket. Some of them react to it, don't really care. Some of them have massive impact on, and it drives that dispersion. And that big event, the other key benefit for us if we're investing in is this volatility, and we're getting in at these really low levels, and if that volatility kicks, then it has a big reval on this as well. Peter, g'day Peter. Peter's asked the question, can you redeem the investment early if favourable, or must it be held to maturity? Yes, you can redeem it early, and there are situations where that might be what the product manager recommends. Basically, if dispersion and volatility increase significantly, then in this structure of this investment, we'll start to benefit from it in early stages, and it might be the best thing to do is to take, if that big profit is there, might be to take it. But if it just ticks along like it's done with the other investment we're in at the moment, if you hold it to expiry based on the current levels of the investment, it would be your initial investment would have tripled. There's big ifs around that. It won't necessarily stay up there and so on and so forth. We'll disclaim that. But you're going to benefit later on in the life of the investment because of the time decay in delta and the increase in delta, Peter, which will benefit that investment. So you can get out early, but you'll need the big event to occur. So let's say there's a significant market correction or geopolitical event, volatility and so forth come up, then most definitely it would be worth looking at redeeming. But someone that came in now, for example, who wanted to get out, they can get their money out because circumstances change or view changes and so forth. You just won't get, it's designed over a 2-year period, or it's designed to benefit if there's a big move. Does that make sense, Peter? Is there any other questions? Let me go back. I think there might have been a couple up the top that I missed. I hope I answered your questions earlier. And for those that haven't requested the IM, type in yes. All right. Me's asked the question, penalty for early redemption, though there are no fees or penalties for early redemption. All right. And it says in the prospectus or the IM that there's 3 quarterly redemptions. If you call us up, and I know the product manufacturers very well, we hold influence in there. If someone needs to get out, it can be, we can put things in motion at any point in time. Don't have to wait. IMs usually say once every quarter, and I guess if you call them up directly, they'd say that. But if you contact us, we can coordinate things so they happen when you want them to happen. All right. So speak to David Sells as well. He looks after all these types of things, and he's got great relationships in with all of these firms, so holds good sway. All right. If dispersion spikes, can I unwind my position? That was from John. I think I answered that with Peter's question. Who chooses the stocks in the basket, and why have these companies? I think we kind of referenced that. They're chosen by the product manufacturers. The guys who put the investments together do a lot of analysis to choose these. They specifically choose them because they believe the dispersion between them can increase. Volatility is just low across the book, so it's probably not a factor that they're looking at. Yeah, that's how they put them together. All right, Bronwyn, we'll get the PDF sent, the doc sent across, no problem at all. Yeah, the stocks are owned by the product manufacturer, so all of that information is outlined in the IM, and yeah, they manage the investment and value the investment, and so that's something that there is a formula for. You can read that, and it's certainly something that we, you know, these are big firms. We're not concerned about big international players. Yeah, so there is a formula for working this stuff out, and you can read about it in the IM. All right. Any other questions, anything else that I can help with? So if you haven't already, for all those people that have typed in yes, we will get that IM sent across to you. If anyone else, any other questions, please feel free to put them in. All right. Mia's asked about management fee. All the fees are built into the investment, so there's no additional fees on top of that. So they're built into the interest rate that is charged. So the only fee that you're looking at, there's two. One is the interest rate, and the other is the advisor fee from the advisor. All right. All right. Yes. Okay. So to all those people that typed in yes, we'll get that sent out to you. Have I got yes to receive information memorandum? Again, look, you know, for us, we are looking at volatility all the time. I probably could just show you some of our analysis on it. We're actually next week. I have the head of derivatives, equity derivatives from the ASX, and the developer of TradeFloor, who's built the risk management systems that most advisors, options advisors, use in Australia. We're running and myself, we're jointly running a session on volatility. We're going to be talking about volatility, where it's positioned. We've built a lot. We built a system called implied volatility, so it's obviously spent a couple of years building it. It's obviously something that we think about quite a lot, and at those levels of volatility and how you can use volatility in the sense of trading. This is one of the ways of using it as an investor. Right, and if you're looking for an investment that can benefit from an increase in volatility, then this is one of those investments. But again, it's a way of putting a hedge in place where, you know what, it doesn't actually matter if the market goes up a lot or down a lot or whatever, right? There are many things that can drive volatility from the very low levels that it is at the moment. So you could set this investment up like the one we've had recently, and just benefit from the dispersion of the stocks that have been put together, and do really well out of it. Market could go up a bit, come down, a bit more volatility, could go back to normal levels, and this investment can do really, really well. But if something happens, a black swan event or something that's on the horizon now that we're just hoping doesn't escalate, this investment is a potential hedge for someone, or it is a way of just making straight money out of it. And we know there are plenty of investors that are just looking for yield at the moment, are trying to avoid exposure as much as possible to equities. And for those, plenty of people have looked at this as a way of just setting up a position. And the other great thing about it is because of the size of the leverage on it, means you don't have to, you can take a decent position without having to outlay relative, I always have to say relatively huge amounts of money. All right, so anyway, there you go. So if it's something that you're interested in, type in yes. Alternatively, I know a lot of you speak to David or Blake or Michael. Have a chat with them. They can give you more details around it and help you with any paperwork that you need. If you're someone that has used these types of investments in the past and you would like someone just to pre-populate a PDS for you with your details and send it to you for you to review, just type in yes. And we'll get that sent through. Wholesale, not a wholesale investor. Unfortunately, I'm putting pressure on them to look at putting something together for SMSFs, but this issue is only this particular product is only for wholesale investors, right? So apologies, but that's the way it is for this one. But I am putting pressure on them to provide something, and certainly if it's something you're interested in and you would like me to do that, I'll try and get something. It's just a little bit more expensive for these guys. They generally don't do things in the retail market on these particular products. So, all right, is there any other questions, anything else I can help with? Other than that, thank you to everyone for taking the time to come along to the session tonight. You know, if there's anything that you need in way of follow-up, please let us know. Otherwise, thanks, and have a wonderful night. Cheers.